Students, remember it is a revision session and the first topic that we are going to discuss is capital market analysis, and what I expect from your end is before joining these sessions or watching this video, just have a look through what you have completed in capital market analysis, and through this session you can rapidly cover the topics. So when you are preparing for CA final examination, it is always expected that before 2 months of the examination, you must have completed most of the topics, and you must have solved numerous problems relating to a particular topic. Now, the first topic that we are going to discuss for CA final examination is capital market analysis. So when you think of capital market analysis, just chat out how will you cover the total topic, theoretically as well as practically. When you are reading capital market analysis, remember my friends, first thing first, you will first understand about the capital market. Okay, first try to cover the basics of the capital market. Second, you go to different instruments in the capital market. Third, you go to the valuation of the different capital market instruments, how the valuation is made. Fourth, you go to the risk associated with the capital markets, what are the different risks, how the risk is estimated, and all those things. And finally, the risk management practice in capital market. That means how to estimate the risk that you have already covered. Then finally, we'll look into how to hedge the risk, how to minimize the risk associated with the capital market, how to take position in the capital market so that your overall risk will be minimized, or otherwise I will tell you how your return will be optimized. Okay. So these are the 5 things that you should learn in capital market before going to the examinations. Basically, practical point of view से मैं आपको बता रहा हूँ. So what is capital market? That is the first thing that you should cover. And while going through what is capital market, what is primary market and what is secondary market. So you know, primary market is the market where company directly issues shares to the public. There are 2 types of companies. One is private limited company and second is public limited company. A public limited company, when it gets listed in the recognized stock exchange, then it is capable of raising fund by issuing shares to the public. So when it raises shares by issuing shares to the public, it is done through the primary market. So primary market is the market from where company directly gets the fund. Once company raises fund through initial public offer or following public offer, thereafter the shares in case of initial public offer are get listed in a recognized stock exchange, and that recognized stock exchange through which the shares are easily transferable among the different investors or different participants of the market, that is known as the secondary market. So stock market is the secondary market. So once shares are issued, the money comes to the company. Money is used by the company for the long-term purposes. Remember it. When shares are issued, money comes to the company. That is issue of share capital, and that money cannot be used for short-term benefits. Those should be used for the long-term benefits of the company. Now, once the shares are issued, they are listed in recognized stock exchange, and thereafter the shares are transferable among the investors who want to purchase or sell the shares. Then the money do not come to the company. But what happens, suppose from the secondary market, I purchase the share from one person, say Mr. A. Then it is purchased through brokers. There are several brokers, market participants, they are brokers. Through those, I purchase the shares. And what the company do? There is T+2 settlement. Thereafter, the company removes the past member's name from the stockholders register and insert my name. So all this settlement take 2 days time, and that is the reason why it is known as T+2 settlement, trading day plus 2 days settlement. It is a revision, so I am not going into the depth. Just I am revising the topic for your best convenience. Okay. Now, in secondary market, you buy and sell the shares. Okay. Now, at what price I am buying and selling? The buying and selling is done through the price mentioned in the stock market. So stock market में क्या होता है? There is day-to-day purchase and sale of shares. Depending upon the demand and supply of a particular share, the price is determined. So price is economically determined on the basis of demand and supply of the securities. Okay. Now, if the demand is high, then the price will move up. If the demand is low, then the price will go down. Now, as you see, there are a lot of halla balla regarding Adani group of companies shares and all those things. So, when price of the shares goes up or goes down, okay, you cannot say that the upward trend or the downward trend is due to the factors of the business of the company only, okay, because there are sentiments and there are manipulations in the market possible through which the price may move, okay. So if someone gets news that Adani Group is going to develop such a big project in the coming 1 and 2 years, then people's sentiments will be affected and people will try to purchase the shares because they will think that the price is maybe rupees 400 or 500. If the project is implemented, then the price may go up to 1000, so my money value will rise 2.5 times within next 1 or 2 years. So people will buy it, and once people start buying the shares of the company, the market price will go up, okay. So these values what are reflected in the stock market necessarily reflect the people's thinking about the company, okay, and how they are reacting to different marketing news relating to the company. Now let us come to, these are the two markets, primary market and secondary market. When the company first time issues shares, okay, in initial public offer or through right issue or through following public offer, whatever it may be, then in that case the company has to mention a price at which it wants to sell the shares, okay, कौन सा price में वो share को sell करना चाहेगा. Now it is a quite important issue because there is no listing of the shares prior to initial public offer. So how the company will value the shares while issuing to the public? So they need to take the help of merchant bankers, okay, who are expert in valuation of the shares, okay. So they make a fundamental valuation of the company. So there are two types of valuation of the company. One is fundamental valuation and second is technical valuation. So you have to learn before going to the examination what is fundamental valuation and what is technical valuation. So fundamental valuation means I take the balance sheet of the company for the last 3 or 4 or 5 years and I look into the trend of the company, the profitability trend of the company, the turnover trend of the company. I do not just look into just profitability. I look into turnover, how the turnover moved during the last 3, 4 or 5 years. And I will definitely take into consideration the management policy, management practices and how they affect the profitability of the company and how the profit move up during the last 3, 4 or 5 years. The most important aspect here is not the profit but the cash, how much cash the company is generating. That means cash flow is very, very important. In addition to that, just looking into the past is not enough. We have to look into the future prospect of the company. So we have to look into what the board of directors have taken decision and the purpose for which they want to raise the fund of the company. Obviously, suppose the past capital of the company was rupees 3,000 crores and now they want to raise rupees 5,000 crores for taking new projects, okay, for implementing new projects, then obviously the cash flow will change. And second thing is that it is not that what rate of return the company was getting earlier, that rate of return will continue because the new business may bring additional cash flow and the rate of return or return on investment may be more than what they were getting for last 4 or 5 years. So we have to make an analysis how the company will perform after realizing the fund and utilizing the fund in the new project. What will be the future cash flows? That we call as projections. So we will make projections of cash flow for the future and thereafter we have to make the discounting of the future expected cash flows and from that we need to make the valuation of the shares. How to make the valuation of the shares? We will look into that in future, okay, in my revision classes, of course, okay. But for the timing, you just keep in mind, yes, I have to project the future cash flows. Okay, after projecting the future cash flows, I will discount the future cash flows. How to make the discount? I will make the discount on the basis of the cost of capital of the company. Now the question is how to estimate the cost of capital of the company. We'll look into that. But for the timing, you just take this factor into consideration. In the merchant banker, while making valuation of the company, will take all these factors into consideration. One, how the future business of the company will perform. Two, what will be the future cash flow of the business. And they will estimate the discount rate at which they will discount the future cash flow and they will find out the discounted cash flow and value of the business. One aspect. They may take into consideration the net asset value approach for the purpose of valuation of the company. They will take some methods for valuation of the shares of the company and they may take an average value of all those and they will fix a price band. Now the question is, what is price band? Price band is the minimum price, okay, at which the shares are expected to be traded immediately after listing in the stock market, and a maximum price at which you have to make the bid. Now in case of initial public offer, they fix the price band. Suppose the price band is 450 to 480, then people will make bidding, okay, and at the highest bidding the shares will be listed in the recognized stock exchange. Okay, once the shares are listed in the recognized stock exchange, then it is easily transferable. That is one of the very important characteristic of public limited companies. The shares listed in the recognized stock exchange are easily transferable among the public. ओके, पब्लिक जो भी शेयर को परचेज करना चाहेगा वो इजीली उसको बाय कर सकेगा और सेल भी कर सकेगा. नाउ द क्वेश्चन अराइजेस, हाउ द प्राइस बैंड इज डिसाइडेड. Obviously, when I find out the price of a share by means of different valuation methodologies, it is not that what price I am finding out that will be absolute one. So I make an upward of 10% or maybe a downward of 10%. So by taking into consideration the upward and downward pricing, I decide the price band, and under bidding process, book building process or bidding process, the price is finalized. Okay, then the bidding process starts, and the highest bid price is the price at which the shares are listed in the recognized stock exchange. Thereafter, immediately people will try to buy and sell the shares in the open market through the recognized stock exchange, and depending upon the demand and supply of the shares, the price may move up or move down after listing of the shares. This is the way the initial public offer is done. So very simple thing. Suppose you are a public limited company, you get your company listed in a recognized stock exchange, then while issuing shares to the public, you have to make the valuation through a recognized merchant banker, and the price band is decided and the bidding process starts. These things you have to look into, and in detail there is a SEBI guideline how the bidding process is done. So it is expected that while preparing for the examination, you will look into the SEBI guidelines also. Now, my friends, you remember two things. Whenever you are preparing for such topics, you not only prepare for the strategic financial management, you are simultaneously preparing for the corporate law. Okay, so in corporate law, there is SEBI guidelines, there is Companies Act provisions regarding all these things. So please look into all those aspects thoroughly while preparing for the topic, so that simultaneously we'll cover the strategic financial management theoretical part, and simultaneously we are covering the कॉर्पोरेट फाइनेंशियल रिपोर्टिंग. एंड सिमिलरली स्टॉक मार्केट ऑडिट का भी एक पेपर है एडवांस्ड ऑडिटिंग में, सो उसका जो एस्पेक्ट्स है वो भी आप साइमल्टेनियसली कवर कर लो. ओके, बी फास्ट, try to remember the things, do not take everything by heart, just try to have conceptual clarity relating to the topic. ओके, सो प्राइमरी मार्केट हो गया, सेकेंडरी मार्केट में चला गया. नाउ सेकेंडरी मार्केट में शेयर्स आर सोल्ड रेगुलरली बेसिस. Now, in secondary market, it is not that the price what is reflected in the secondary market, that is the fundamental price, because fundamental valuation is made on the basis of actual performance of the business of the company. But in secondary market, as I have already told you, the price is determined on the basis of supply and demand. So as the price is determined on the basis of supply and demand, so obviously, okay, there is a statistical aspect in the valuation of the shares. This is known as technical valuations. So valuation of the shares is made in two ways. One is fundamental valuation and second is technical valuation. Now you have to understand what is the difference between fundamental valuation and technical valuation. Suppose I am a long-term investor of the company. I want to keep the shares of the company for a long time. Then obviously, if the company's fundamental is strong, then I will invest in the company. Now, how the fundamentals of the company are identified? The fundamentals of the company are identified through its financial statements. Now, what are the financial statements? My dear friends, when you are looking into the financial statements, you have to know about the components of the financial statement. The components of the financial statement are 1. Balance sheet of the company, 2. Profit and loss statement of the company, 3. Statement of changes in the equity of the company, and 4. There is cash flow statement of the company, and 5 is the explanatory notes. So whenever you are making a fundamental valuation of the company, because you are CA final students and it is expected that you have to go through in details about all these things. So whenever you are making the fundamental valuation of the company, you have to take into consideration all the financial statements of the company. If it is a big company, it has to compulsorily maintain all the compulsorily prepare all the financial components of the financial statements. Now, my dear friends, you have to look into the explanatory notes also very seriously. Why? In the explanatory statements, they mention the accounting policies. What accounting policies the company followed while preparing the financial statements of the company. So all those accounting policies that company followed, you have to minorly look into. आपको minorly देखना पड़ेगा. Okay. Suppose there is changes in accounting policies, then obviously the profitability of the company may have been affected due to the changes in the accounting policies, and how that has affected the profitability or cash flow of the company, that you need to make the adjustments. Okay. So if a question is asked while making the fundamental valuation of the company, of the shares of the company, what factors you need to take into consideration, then obviously this thing you have to mention. I have to go through the explanatory notes very seriously relating to the accounting policies. For example, suppose an item is extraordinary item, then the nature of the extraordinary item I have to look into. Since it is an extraordinary item, it may not recur in future. So then obviously it has increased the profit of the company in the particular financial year, but that item may not be there in future. Then obviously I have to ignore that item while making the valuation of the shares of the company. For example, suppose the company sold a property. Then properties are normally not sold in the ordinary course of business because it is a fixed asset. Suppose the property is obsolete or there is some constraint due to which the company sell the property of the company, then the profit made through the sale of the property, that is not a recurring profit. That will not affect the profit of the company in the future. So while making the valuation of the share of the company, I have to ignore that because in future that profit will not arise. There may be a substantial increase in the profitability of the company due to the sale of the property or due to any other extraordinary item that may not occur in future. So if I want to make the valuation of the share, then I have to ignore all these things, and obviously I have to take into consideration the taxation part relating to that. Okay, so very much carefully, and you need to have a very sincere effort while looking into the explanatory statements of the company. Thereafter, you take into consideration the profitable statement, profit statements or profit and loss statement, and you find out the cash flow. Now, the cash flow need to be calculated on the basis of what? Operational statements of the company. What cash flows are mentioned in the cash flow statement may not necessarily be required for the purpose of valuation of the shares of the company. So if I want to make the valuation of the shares of the company, then I have to look into the operational efficiency of the business of the company. So part 2 is identifying the cash flow of the business. So cash flow may be categorized into several parts. So remember, my friends, while making a revision, you should go through the different types of cash flow. One, the two basic cash flows that you have to consider is free cash flow and free cash flow to equity. Free cash flow is the cash flow which is available to all the investors. All the investors, matlab equity shareholders as well as the debt providers, equity preferred stockholders as well as the debt providers. But free cash flow to equity is the cash flow which is available to equity shareholders only. So whenever you are calculating the free cash flow, you have to discount the cash flow on the basis of weighted average cost of capital. So you have to find out the weighted average cost of capital and you have to discount those cash flows on the basis of weighted average cost of capital. But when you are calculating the free cash flow to equity, since it is the cash flow which is available to the equity shareholders, the valuation should be made on the basis of cost of equity. That means you have to find out the future cash flows of the business and you have to discount at the cost of equity. Now the most important issue arises how to calculate the weighted average cost of capital and how to calculate the cost of equity. My dear friends, let me first go to weighted average cost of capital. It is a revision session, so I am going little bit fast, but whatever I am saying in this session, you just note them in your paper. आप आपके पेपर में नोट डाउन करो और उसके डिटेल में आपको जाना पड़ेगा बिकॉज टाइम इज वेरी लिमिटेड, वेरी रेस्ट्रिक्टेड. सो वी हैव टू कवर द टॉपिक्स. सो वट एवर टॉपिक्स आई एम टचिंग, यू हैव टू बी लिटिल बिट केयरफुल ऑन दैट. सो free cash flow to equity and free cash flow, these are the two very important aspects. Free cash flow will be discounted at what? Weighted average cost of capital, and free cash flow to equity should be discounted at cost of equity. Now free cash flow discounted at weighted average cost of capital. What is weighted average cost of capital? Weighted average cost of capital is equal to weight of equity multiplied by cost of equity plus weight of debt multiplied by cost of debt. What is weight of equity? Weight of equity is percentage of equity in the total capital of the business. So you need to find out total equity. Matlab equity share capital plus reserve and surplus. 2, you have to calculate the total debt. So find out total equity plus total debt. Total equity divided by total capital is equal to weight of equity. Total debt divided by total capital is equal to weight of debt. Then you find out cost of equity. How to find out the cost of equity? The cost of equity, so you have to go to the cost of capital concept, okay, to find out the cost of equity. Cost of equity calculation. Again, I am revising, so I am rapidly saying it. Go through them in detail while preparing for the examination. Cost of equity is calculated as below. Cost of equity calculation on the basis of what? Cash flow of the business or on the basis of profitability of the business. Calculation on the basis of risk associated with the business. So two types of calculation. Type 1 calculation on the basis of profitability. Second type of calculation on the basis of what? On the basis of your risk associated with the business of the company. Now calculation on the basis of cost of profitability of the business. Obviously one method is dividend capitalization method. How much dividend the company is distributing among the shareholders and what is the price of the share. So last year mein what was the price and what dividend the shareholders are getting, because dividend is not the sole return of the business, so practically this method does not apply, but still KE is equal to D1 by P0. P0 means today's price, D1 is expected dividend after 1 year. So find out the expected dividend after 1 year, divide it by the present price, you will get the cost of equity. It is not an appropriate method because dividend is not the only return that the shareholders are getting. So when you are calculating the cost of equity, remember my friends, it is calculated on the basis of expectation of the shareholder. It is not just calculated on the basis of actual return given by the company, because if the company does not meet the expectation of the shareholders, then the shareholders will not keep their fund with the company. They will sell their shares, and once the sale is more, the price of the share will come down. Then obviously the company has to look into the expectation of the shareholders, okay, while making the estimation of the cost of equity. Then EPS method. EPS method is a superior method as compared to dividend method, because here we are taking into consideration both the distributed profit as well as the retained profit. So EPS is equal to DPS plus retention. Okay, so when I divide EPS by P0, expected earning per share next year divided by P0, then I get the return on equity, or what we call as the cost of equity. Since I am calculating on the basis of expected EPS of the next year, so I am estimating the expectation of the shareholder, so we call it as the cost of equity on the basis of EPS. Okay, but another method is there, ki what is the price appreciation. Now these retained earnings, what we are taking while taking the EPS model, are reinvested in the business of the company. So retained earnings, when reinvested in the business of the company, they again give return to the company. Therefore that is reflected in the market price of the share. It is assumed that the future market price will not only reflect the dividend, it will also reflect the retained portion which is reinvested and the return on the reinvested portion, and it will be reflected in the future market price of the company. So while calculating the cost of equity, I take into consideration, one, what dividend I am expecting in the next year. Second, what capital appreciation I am expecting in the next year. So this is known as Modiglian and Miller approach, whereby I find out the cost of the equity on the basis of, one, dividend expected in the next year, second, price appreciation expected in the next year. So D1 plus P1 by P1 minus P0 whole divided by P0, because I am investing today P0, and upon investment of P0 I am getting two returns, one dividend D1 and second price appreciation P1 minus P0. So my overall return is D1 plus P1 minus P0 divided by P0. So this is one way of calculating the cost of equity. Okay, so if you ask, sir, how the valuation of the share is made, then आज का प्राइस जो है शेयर, यू हैव टू कैलकुलेट द P0. सो फ्रॉम द वैल्यू KE इज इक्वल टू D1 प्लस P1 माइनस P0 डिवाइडेड बाई P0, यू कैन मेक द रिवर्स कैलकुलेशन. KE इंटू P0 इज इक्वल टू D1 प्लस P1 माइनस P0, और KE इंटू P0 प्लस P0, ओके, इज इक्वल टू D1 प्लस P1. ओके, or from that you can find out the value of the P0. Okay, K into P0 is equal to D1 plus P1 minus P0. K P0 plus P0 is equal to D1 plus P1. Then you take into consideration what the value of the P0. Okay, P0 into 1 plus K is equal to D1 plus P1. Okay, or P0 is equal to D1 plus P1 divided by 1 plus K. So when I reflect D1 plus P1 divided by 1 plus K, then I am finding out what I will get after 1 year. After 1 year, I will sell the share and I will get P1. I will get the dividend, that is D1, and divided by 1 plus K. This represents the present value. So present price of the share is nothing but the what? Present value of future expected dividend and future price of the share. That is reflected by means of D1 plus P1 divided by 1 plus K. D1 plus into D1 plus P1 multiplied by 1 divided by 1 plus K. 1 divided by 1 plus K is equal to present value. Okay. So present value of future dividend and present value of future price is reflected in the what? Cost of equity of the share. So these are the different ways of calculating the cost of equity without using the risk factor. How the value is cost of equity is calculated by using the risk factor, that we'll discuss in the next session. Thank you for your patience hearing. We'll meet very soon. Thank you.